VIX short-term futures, ETN, short-term futures, ETN, okay? So what do these guys own? What do they actually own? Well, they own volatility products, right? It's as simple as that. That's what they buy into, is volatility products. It offers exposure to futures contracts of the VIX index, not just the first futures contract, first and second futures contracts. It offers exposure to those short-term futures. In other words, it's obviously going to have a forward value against the VIX itself, right? Because the VIX future is a forward value to the VIX, correct? Does everybody understand that? The VIX futures is a forward value to the VIX, just the same way as a futures, S&P futures is a forward value to the S&P, yes? There's an expiry to the S&P in X number of days' time, so the future is a forward value for the current stock price. Everybody knows that, yeah? I assume so. The oil's futures contracts are a forward value against the oil price, right? The oil price is available today for baseline oil, and then you've got the futures contract, which is oil in however many days till expiry. Everybody understands that. You must understand this because of very obvious reasons. It's important when we build out things like calendars that we understand that this is indeed the case. Why is this of any importance to anybody on the planet? Well, let's take a look at the S&P, and when we look at the S&P, one of the things we're looking at here is a 1-minute chart. You can see I've drawn in my levels from yesterday. I've drawn in some change of behaviors, wholesale prices, and all the various other things. So we've drawn in some levels from yesterday. And now what I want to do is I want to look at the relationship of those levels against volatility. So let's take a look at the volatility calendar. And it's done as a positive correlation in this respect. It's done as a positive correlation. So on the basis that this is done as a positive correlation, this is VXX minus VIX. It's really just valid for the US session, but during the UK session, it is, of course, volatility on its own. We can see that there is a divergence at these higher highs, and that leads to a very nice sell-off yesterday. And into the bottom edge here, there was the early stages of a divergence. Now let's take a look at VXX times 2 minus VIX. Why would we do that? Because then we can see whether there's a supply or demand for VX, correct? So when I do VXX times 2 minus VIX, does anybody see any divergences that are worthy of trading? Well, of course we do. We can see, for example, yesterday, literally yesterday, you can see that the orange line coming into the US session is significantly discounted on where it was yesterday. We can see the blue line is actually premiumed to where it was yesterday. So what does that tell me? That tells me that as an arbitrage, I could buy the orange line and sell the blue line, correct? Yes or no? As an arbitrage. If I buy the orange line and sell the blue line, what have I just done? I've bought 2 volatility and sold 1, so I'm long 1 volatility contract. If I'm long 1 volatility contract, have I got a sell trade? Possibly. But the volatility still has to diverge from price. So whilst I've got very visibly a sell trade here, I still need to see divergence against price at the top edges. And that's what we got on volatility. We got a divergence. If you look at the volatility line here, it only just goes up by literally a couple of ticks. The price is significantly higher. So in other words, if I drew the volatility narrative there, from the high to the low here, sorry, from this high to this high here, the price shouldn't have been that high, guys. The price should have probably stayed at around about 38s. Well, I'm selling at 50s. I've got about 12 points of value in that trade before the market sells off. Now, if I look at what happened this morning, early diddles, take a look at what happened this morning. The orange line has flipped over from the blue line. In other words, I'm now selling orange lines and I'm now buying blue lines. If I'm selling orange lines, what am I buying? The S&P. Why? Because I'm selling orange line, I'm selling 2 volatilities and buying 1 volatility. If I'm selling 2 volatilities, I am bullish equities. So if I'm bullish equities, what I've now got to find is the blue line and the orange line rising. So into the bottom edge, I start looking for the blue line and the orange line rising. We had it here. We had it here. Prior to this drop lower here, we had it in those two locations. And Bob your auntie, we absolutely killed it. We absolutely killed it. And then we start seeing a divergence at the highs. I sell into that divergence. And obviously I get a very, very easy volatility sell coming away from those prices. Life cannot get any better, cannot get any easier. It was fabulous. Now I'm obviously concerned about what's happening just now in equities. We're starting to see a bit of a divergence creeping back in here. So obviously as we come up into these areas here, we've got that change of behavior here for that bracket sell. So we could be putting ourselves into a little bit of a bid watch, an offer watch into those higher prices. And obviously we can then default into the supply demand line from the sentiment line, which is this green line. And you can see the sentiment line has never gone bullish. It's never gone bullish. So that's making an even bigger case to be working on the short side just now. The short side just now, to see if we can capture a little bit of a spike in volume, but we're just ahead of the cash open, so I'd prefer to leave this until the cash open. And if the value stays offered, then of course we might be able to run the stops on a game play to the top side here. We might be able to scoop up some stops on a sweep higher for a possible sell coming in, but get ready to make that volatility read when VXX starts to really print some data. We can get a really clean read when that happens, guys. So be prepared. Cash open in just 10 minutes.